2/3 of Canadians will receive a tax return this year, but 13% of Canadians will have an amount owing to CRA.
And the last thing that we all want is to leave money on the table when doing our income tax. That is why today we're going to share a few powerful tax hacks that could help you save thousands of dollars over the years.
Let's go! If you moved 40 kilometers or more for work, or to start a business or to attend university full-time, you can claim your moving expenses.
I actually knew about this deduction when I moved from Montreal to Toronto 5 years ago for a job, and I was able to claim direct moving costs like help of movers, moving truck rental, and gas expenses for that truck. What I didn't know I could deduct was parking fees, storage unit fees, flights, and even costs to sell the old home, if only I owned the home at the time. But how cool is that? If you are a homeowner and sell your home, the fees that you pay, which aren't small, like real estate commissions, legal fees, and mortgage penalties for breaking your mortgage, all of these things can be deductible.
If you are renting and have to break your lease early to move for a job, you can claim the penalty fees as a moving expense.
And if you need to stay somewhere before moving into your new home, you can also claim up to 15 days of hotel costs and meals.
One thing you cannot do, though, is go all out on splurging on your move. Your moving expenses are deducted against your new employment income in the new place. Or if you're a student, it cannot be greater than your award or scholarship income you received that year.
Some employers also offer moving cost reimbursements, and if that's the case for you, you can only claim any additional expenses that you paid yourself. You can't really double dip, so make sure to subtract any employer reimbursements from the claimable amounts.
If you're watching this and you have a family or a spouse or kids who earn significantly less than you can do two things that will help you reduce the amount of tax you pay. First, if you earn pension income and would like to lower your tax burden because you have a side hustle business, let's say, you can legally transfer up to 50% of your pension income to your lower income spouse, and that will reduce your own taxable income.
Here's another way that you can split income. For instance, if your kid or spouse help you with your business, be it simple administrative tasks or deliveries, or even marketing on social media, let's say, you can pay them a salary, which will lower your own taxable income. The money stays in the family, but now your business, whether it's a sole proprietorship or a corporation, is taxed on a lower income amount.
Another option for high-income earners is to keep more money in the family by setting a family trust. A family trust is created by a settlor, the person who establishes the trust, and is managed by a trustee who controls the assets. The beneficiaries could be your spouse, your children, or other family members, and they will receive income from the trust.
This lets you distribute income among family members in lower tax brackets, reducing the overall tax burden. The trust can distribute investment income, rental income, or business profits. If you hold assets like stocks or real estate in your family trust and later decide to sell any, the capital gains can be allocated among beneficiaries instead of being taxed at the highest rate right away for you. This setup has many specifics, so if you think that this is something that you and your family can benefit from, we recommend to speak with certified legal and accounting professionals before you get started. In the opening of this video, we've mentioned that 13% of Canadians are estimated to have an amount owing to the CRA this year. And the estimated amount owing by the CRA is $6,000. And the worst part is that you often have to pay with your debit card, missing out on all the potential credit card rewards. And this is where Chexi comes in, who also kindly sponsored a segment of this video. Chexi lets us pay our bills, like our taxes due, with our credit card. This allows us to earn tons of points and a lot more cashback every year. So let's say that you have a credit card that offers great perks, like the Scotia Momentum Visa Infinite, which typically offers a 4% cashback. By the way, they actually have a limited time 10% cashback promotion going on right now. With that card, paying $6,000 in taxes would earn you $240 in cashback. With Chexi fee of $105, you will pocket the difference on $135 in cashback. And all you did is just pay taxes. If you're into points, you can use a card like TD Aeroplan Visa Infinite Privilege. With this card, the same $6,000 tax payment would earn 7,500 Aeroplan points. Imagine paying for your next vacation flights with your tax payments. Here's how you can earn these points. You create an account on Chexi, you choose the tax payments that you want to make. Here you'll have to enter your social insurance number to make sure that the tax payment goes to the right person. This data is securely encrypted and stored only for payment processing. Then you will choose the amount that you owe and the card that you want to pay with. 3 business days later, Chexi will submit your tax payments to the CRA or Revenue Quebec. It's the only way to earn rewards from paying taxes. So if you want to maximize your credit card benefits and turn not just your tax payments, but also any bill payment from rent to car lease or utilities into rewards, you can sign up for Chexi using the link below. When you use our link below, you will start with a $15 bonus, and for every friend you refer, you get your Chexi fees reduced, allowing you to make even more cashback returns. So make sure to get your friends on board as well. Thanks Chexi for sponsoring the segment and helping Canadians pay their taxes smarter, not harder.
This next tip is one of the most powerful ways to optimize your income and tax paid. The only thing is that this method is only available for those who are self-employed. Folks who work for themselves, create value for others, and essentially run their own small business.
The most common example we can use is driving Uber or food delivery. But you could also tutor math or physics, or work as a handyman or woman on the weekends.
Or if you have a hobby, you could turn it into a business.
So depending on type of the business that you run, you could deduct your phone bill, your internet, and even your laptop as a tax deduction. If you earn less than $30,000 per year as a side hustle, you don't need to do much. But as soon as your revenue exceeds $30,000 a year, you'd have to register as a sole proprietor for the GST and HST tax and collect sales tax for your products and services, which will later have to be given back to the CRA.
If you want to learn more about it, you can start by Googling how to register as a sole proprietor in your province, and follow the link on canada.ca or your provincial website to learn about how to do that. Or let us know in the comments below if you would like us to cover it in a separate video.
Once you have a business, expenses related to running your business will become legitimate tax deductions, which will help you lower taxable income that you will be making from that business.
For example, you use your phone for driving Uber 20% of the time. That means you can deduct that 20% of your phone bill from the income you make from Uber. If you run an online business and use an office in your home, you can deduct the portion of your rent, but several rules apply, so make sure to check them out on the canada.ca website.
You can even deduct things like meals if you're taking a client out for dinner to close a deal.
All you have to do is make sure to keep receipts, keep a record of every business activity, and use a separate business account to make tracking expenses easier. Don't go crazy, be responsible, because CRA will come after you.
The next hack is literally free money, no jokes. The key here is to find an employer who offers an RRSP matching program, and not all of them do. And if they do, not all employees actually take advantage of it, which is unbelievable. Here's how this program works. First, you sign up for it through your employer. Once you're signed up, you, the employee, will contribute, let's say, 4% of your salary to an RRSP account. This contribution will be just automatically deducted from your paycheck by your employer. With the RRSP matching program, your employer matches a portion of your contribution. So if you contribute 4%, your employer does too. It's as easy as that. It's literally free money from the employer that you don't have to even think about or do anything about, except commit to putting away a portion of your income into RRSP every month. This is one of the best ways to increase your total savings without any additional effort.
Some companies may impose some contribution limits or vesting period, meaning you must work for the company for a certain period before you can fully own the employer's contributions. If you leave the company before this period, you may lose part or all of the employer's matching contributions, so make sure to read your contract.
And no matter what you do, always keep an eye on your RRSP contribution limits each year. You can find these numbers in your CRA account online.
The downside is that these employer-matched RRSP accounts are managed mutual funds that you have little control over, and they charge nasty fees eaten away from your potential investment earnings compared to if you were to invest on your own into a selected list of ETFs, for instance.
So when you do leave your employer, make sure that you transfer all that money out of your RRSP into your own self-managed RRSP account or something that offers much lower management fees like Wealthsimple, for example.
You might know that making donations to charitable organizations is also tax deductible. But what you might not know is that instead of donating cash, you can donate stocks or ETFs with capital gains instead of cash.
If you invest, you might actually prefer that option, because normally when you sell an investment at a profit, you pay the capital gains tax on the increase of value. So when you donate investments directly to a charity, you avoid paying tax on the capital gains and still receive a tax receipt for the full value of the stock that you donated.
This means you get a larger tax deductions for your donations while keeping more money in your pocket.
So here's an example. Let's say you bought 100 shares of a stock 5 years ago for $50 per share, and you've spent $5,000. Today, that stock value has doubled, so your total investment now is worth $10,000. If you sell the stock, you would owe the capital gains tax on the 50% of the profit, $2,500. Assuming a personal tax rate of, let's say, 30%, you would kick $375 back to the CRA. This is an oversimplified way to calculate the amount of tax owing, since the actual total tax that you'll pay will depend on your total personal income.
All in all, instead of selling the stock, you donate it directly to a registered charity. The charity receives the full $10,000, you get a $10,000 charitable donation receipt, which you can deduct from your taxable income. This way you avoid paying the $375 of capital gains tax.
Here's something curious. 80% of Canadian mortgage holders pay their mortgage and get zero tax benefits. But there's 20% of people who are able to turn their mortgage interest into a tax deduction.
This is made possible thanks to a readvanceable mortgage. Readvanceable mortgage is a combination of a traditional mortgage and a home equity line of credit. You still need to apply and qualify for it first, and lenders may have limits on how much credit they extend. This option is typically available to homeowners who have at least 20% equity in their home and also have an excellent credit score and have good financials.
With a HELOC, you can re-borrow the principal that you've already paid down and use it for investments. Instead of just paying off your mortgage, you can access your home equity through the HELOC and invest in income-generating assets like dividend stocks, ETFs, or rental properties. This is called the Smith maneuver, and it is a popular Canadian strategy that uses a HELOC to make mortgage debt tax efficient.
The best part is that you can use tax savings and investment returns from the Smith maneuver to accelerate the mortgage payoff. The tax refunds and any investment income you earn can be applied toward the mortgage, paying it down faster while growing your investment portfolio.
This strategy allows you to convert non-deductible mortgage debt into deductible investment debt over time.
Let's look at this example. Let's say you have a $500,000 mortgage, and your monthly payment is $2,500. Of that payment, $1,500 goes to interest and $1,000 goes toward the principal. Each month, you borrow back the $1,000 principal via the HELOC and invest it in dividend stocks or ETFs. Over the time, this creates a growing investment portfolio while making a portion of your mortgage tax deductible.
As long as your HELOC interest rate is lower than your average annual return on investments, you're building wealth without additional out-of-pocket expenses.
Next step is less of a hack and more of just a rule to use every single year. Just turn it into a habit every December. This is especially relevant if you're self-employed.
If you know that you will incur certain expenses next year, let's say you'll take an upskilling or certification course, you can prepay this next year's expense before December 31st. It can include things like rent, subscriptions, and even insurance.
For example, if you prepay $5,000 in expenses now, you could save $1,500 in taxes, assuming a 30% tax rate.
If you've made a lot of money in a given year and you want to reduce your tax burden, and you know that you'll need to buy, let's say, new equipment or a software subscription next year, you can purchase it before the end of the current year and get yourself an immediate tax break in the current year.
Alright, now that you know about these tax hacks, what are your next steps?
Choose the hacks that you think will apply to you and find a lawyer or a tax professional to guide you.
Yeah, don't just take strangers on the internet words for it.
We're not finance professionals, but we use the professionals for our own legal and tax planning. and we highly recommend that you do too.
Even if and when we hire professionals, we always take our time to do our own homework first, because nobody's perfect, and the last thing you want is to blindly trust a professional who may make mistakes.
Canada.ca website is a tremendous resource for all the information on the above hacks that we've shared with you. All you have to do is find some time to do some research.
Let us know in the comments below which of these hacks are new to you, and if you know more hacks. Sharing is caring.
And if you're looking for an easy way to earn rewards while paying your taxes, check out Chexi, because if you have to pay taxes, you might as well get at least something back.
Don't forget to like and subscribe and share this video with someone who needs these hacks.
Thank you for watching, and we'll see you in the next one.
Take care!